Ed Moya, Chief Market Strategist at Oanda. It's nice to see you.
Thank you for having me.
So the idea here and what we're gathering is that they plan to push for some cuts, 400,000, 500,000 barrels per day, led by Russia. The goal here is to support crude prices, right?
Very much so. The Saudis are all in on oil prices. They want higher oil prices. They have their IPO, which is going through their final pricing. And right now, oil markets have been suffering from soft demand. And you're seeing the Saudis trying to balance the market. For this last year of production cuts, they've led the way with over-complying and delivering well beyond what their production goal was.
The Saudis, and it's my understanding Russia is a lead in this as well, in order to not only support the crude prices, but also prevent a glut. And that's one of the reasons why they're really pushing for this big cut. What are your thoughts on what's going on? I mean, Saudi Arabia, Russia, Iraq, Nigeria, right?
Very much so. So when we take a look at who has been complying very well, it's been the Saudis over-delivering, and we've had the Russians who did deliver, finally complied, but that was mainly because of contamination issues. So right now, the Russians are going to have the OPEC alliance group agree upon not counting some oil against their quotas. So this is going to provide the market with some belief that you're going to have compliance from Russia. The Saudis are just going to keep doing what they're doing, and this 500,000 in additional cuts really is how much of it is new and affecting other members. It's not going to be that much, but it is going to be, I think, enough to keep prices somewhat stable.
I mean, they've at least been compliant to this point, but the question is what kind of decisions they make. This probably will go through March, I'm thinking, the next decision overall. The oil stocks, the oil commodity itself. First of all, energy has been the worst performing sector of the last decade. Completely. I mean, while the rest of the market has jumped higher and people are making all kinds of money, people in the energy group have really trailed.
Very much so. It's been consolidation. It makes you scratch your head when you think about why are you having an IPO for Saudi Aramco. And right now, when we take a look at the energy sector, I think you are going to still start to see some firmer prices here. There is growing concern, though, that there's going to be a plethora of new production from Brazil, Norway, Guyana in the first half of the year, and that's not even counting the U.S. production, shale production, which is still going to be near these record levels, and it's going to provide I think a considerably strong range for oil prices, and it's going to keep oil stocks somewhat struggling here.
Yeah, it's interesting because we're all worried about whether or not energy will struggle or break out. And in Barron's over the weekend, they talked about energy as an investment for 2020. And when we look at Exxon in particular, Bank of America Merrill Lynch actually put out a report with a price target of $100 on Exxon, making it its top pick for 2020, and saying that the stock could rally nearly 50%. So the other thing about energy stocks that I've found to be interesting are some of the new regulations and that some of these companies will have to produce or make changes, and that would actually bring in revenue regardless in order to meet these regulations.
Very much so. So the IMO 2020 has really spearheaded a lot of change in the sector, and I think what you're also starting to see is there's the market has become extremely skeptical of cyclicals, and you're going to start to see more defensive plays. And who is going to benefit? Well, the worst performing sector is likely to do that. And when you have so many strong companies that have high dividend yields, I think you're going to see the Exxons, the Chevrons in Europe. You're going to see Royal Dutch Shell and BP really shine. And it's not going to, I think the Aramco IPO did one thing. It really brought the focus to these dividend-yielding giants, and I think you're going to start to see that be one of the main catalysts for us.
So what's the takeaway from this interview? We buy these stocks or don't buy these stocks? Oil goes higher or oil goes lower?
Well, right now I think oil is approaching kind of the upper boundaries of its range. I think there is still some catalysts for some further upside here. When we take a look at like the Exxons and Chevrons, I think they're up only a handful of percentage points this year, while most of the other companies are down significantly. So you're probably going to still see limited weakness, I think, with the giants. Some of the other players, it would be possibly more of a risky gamble, but I think you're going to see further upside here for those two.
All right. Ed Moya, Chief Market Strategist at Owanda. Thanks for joining us on the show.